really two parts to this chapter. The first part dealt with the new standard, which is all about the new 5-step revenue recognition process. You should know that process.
Contract?
Yes. Identify the contract with customers.
Obligation, performance.
Identify the
Separate.
separate performance obligations in the contract.
The
Price.
transaction price.
Determine the transaction price.
And then separate. The separate.
Allocate the transaction price to the separate performance obligations. Recognize revenue as each performance obligation is met. But I'm not just saying memorize it from the standpoint of that. I'm also know how to apply it in those different situations, those homework problems that we did. Remember, we had assignments that had variable consideration. We had problems where we had to allocate the transaction price. I want to use this and just say to the separate performance obligations. That's important. And I think I told you in the handout for GLIME, there is a section of GLIME questions having to do with the new accounting standard somewhere in that material. The second part was long-term construction revenue recognition. And remember, there were two choices: the percentage of completion and the completed contract. We're up to 6.
It's bad traffic on the Bayway. I was coming from Fairhope.
Huh? That's 7 now. Okay, well, we're up to 1, 2, 3, 4, 5, 6. Yeah, we got them all here now. And now remember, if you do the percentage of completion method, there was that 3-step process. That, remember, I started at the very top and said number 1, what was that? Determine overall contract status at year end, at each year end. Determine overall contract status at each year end. What was number 2? Determine the percentage complete at each year end. And then number 3, based on those first 2, you can then determine the income statement data for the current year. Determine the income statement data for the current year. So the point here is that if you memorize that, then when you see the problem, if you get a little rattled, you can say, okay, wait a minute, but what am I supposed to do? Number 1, determine the overall contract status on each year end. Okay, let me take the information they give me and figure that out. And then go to your number 2 and go to your number 3. It's so that you got a process in your mind that you can do. And then completed contract, remember, we don't have an equal choice between percentage of completion and completed contract. We're supposed to default to percentage of completion unless we're not really good at creating those estimates of how far along we are. We're supposed to use percentage of completion. But if we're not good at determining percentage complete, then we fall back to doing completed contract. So please do not try to outguess me as to which type of problem you're going to have.
Is that a challenge?
No, because, I mean, what I'm trying to tell you is I teach the material the same way every semester. And so when, for example, you all thought, ooh, he's gonna give us a diluted earnings per share problem on that second exam. Well, if you are in the class in the fall, there may very well be a diluted earnings per share problem on the exam. Because I teach it, because I told you, I don't try to memorize what's on your exam. I don't pull up your exam before I start teaching the material and say, oh, this is the one I need to emphasize. No, I don't pull up your exams until I'm ready to print them out and make them up for you. So, and I told you, I have a set for fall, I have a set for spring, and I have a set for summer. And I purposely don't try to remember which is on what. For example, in chapter 23, I probably have a direct method problem one semester. I probably have an indirect method problem one semester. And then I have some other kind of problem one semester for statement of cash flows. And I don't try to memorize when is when because I don't want to. Because, I mean, I have never had a job where my boss told me this week, okay, here's some of the things I'm going to ask you next week, so be ready. No. You learn everything, and then whatever I put on the exam, you're ready for it. If you gamble, you could win big, but you can lose big too. Is there anything specific about chapter 18? Yes, sir.
You don't have to go through the problem, but like when you have a loss on the percentage of completion, like the first year.
You're profitable.
Yeah.
You think you're going to be profitable because at the current status says you're still going to be profitable.
Right.
All right? But at the middle year, it says we're going to have an overall loss.
Correct.
Okay? So if it says we've got going to have an overall loss, in the interest of conservatism, we want to recognize the full amount of that loss in the second year. But we also have to wipe out whatever profit we recognized last year on this contract. Because think about it. At the end of the first year, you thought you were going to make $300,000 on the contract. And you were a third of the way through, so you recognized $100,000 of profit. Okay? At the end of the second year, you say, nope, we're going to lose $200,000 on the contract. So now I need to recognize a $200,000 loss. And I need to wipe out the $100,000 that I recognized last year, which just gets me back to even, right? If I wipe out that $100,000 profit, that just gets me back to zero. And now I've got to recognize my $200,000 loss for the current year. So I calculate revenues based on the same way we've always done, and I plug expenses to whatever it has to be to give me my $300,000 loss for the current year, which should give me a cumulative loss of $200,000 for the 2 years, which is what I want. We do not, when we have a loss, we do not recognize a percentage of the loss. In the interest of conservatism, we recognize the full amount of the loss. That's the key thing to remember. In the interest of conservatism, we don't recognize, well, we're 50% of the way through, let's recognize 50% of this loss. No, you get sued by stockholders who say, I should have known you were going to recognize another $100,000 loss last year.
Okay, wait, so in that problem, like.
Which one? Tell me.
Like, the one we did, it was like problem 1811, where we thought we were gonna make a profit the first year, but then we had a loss the second year. Okay, so you're saying that, so you got the 180 by taking the 100 and adding that 80, because since that hasn't even really, is it because it hasn't happened yet? You really didn't make that 80,000?
Yeah, all right. At the end of the first year, you thought you were going to be how profitable on the overall contract. Look at, based on, no, not that one. Up at the top, what's the overall contract status what's step one? What are you thinking at the end of year one? What's your projected gross profit?
400,000.
400,000. Okay, so we think we're gonna make 400,000 on this overall contract. So based on how far along we are at the end of the first year, you said we recognized 80,000 of it. Okay, so then at the end of year two, when you do step one, determine your overall contract status, what does it tell you?
That you're gonna have a loss of 100,000.
Okay, so at the end of year two, it says suddenly you're gonna have a loss of 100,000. So think about that. Not only are you not gonna make that 80 that I told you last year we made, we're gonna lose 100. So the first thing I gotta do is wipe out that 80 that I thought I was gonna make. I gotta wipe it out by increasing expenses by that amount. And then I've gotta recognize the $100,000 loss in total in the interest of conservatism. So I plug that extra 180 into expenses so that I wind up where I want to be.
So your loss that you reckon, like your estimated gross loss at the top for number one is gonna be like your accumulated.
No, it's what your overall contract status is. Yeah, when you finish the contract, you're saying, I'm gonna be in a loss position on this.
But your gross profit for the year is just the 100,000 plus the 80,000 that you.
Right. Because we gotta wipe out the 80 from last year and recognize a $100,000 loss for this year. So we have to have a $180,000 loss in the current year to get us to where we want to be. That makes sense? Because percentage of completion, folks, I mean, one of the first papers I ever wrote was on percentage of completion accounting and the fact that you can wind up being really profitable in the early years of a contract and then be really unprofitable toward the end if you're not good at estimating what your costs are going to be. I mean, at first you're like, oh yeah, I'm rocking and rolling, I'm gonna make $1 million on this contract. And in year two, you're like, well, I'm not gonna make $1 million, but I'm gonna make $800,000. And then in year three, you're like, no, I'm gonna lose 500,000. That's a big turnaround from $1 million profit to a $500,000 loss, and an $800,000 profit to a $500,000 loss. And that was such a big hit in the banking journal that I published it in that they asked me, could they publish it again in another banking journal in a specific state? Because my point was, even though percentage of completion is the preferred method, because it really does give you an idea. I mean, if a company's gonna be profitable on a contract, and it's a 3-year contract, you don't wanna wait till the 3rd year and recognize all of that. That makes it look like the company didn't do anything in year 1, sat around on its butt in year 2, and then did all the work in year 3. That's not representative of what actually happened. So the percentage of completion makes sense. If we're gonna make $300,000 on this contract, and we're a 1/3 of the way through at the end of the first year, we recognize $100,000 of that profit. At the end of the second year, if we're now 2/3 of the way through, we recognize another $100,000, and in the 3rd year, another $100,000. Well, that's all smooth and nice and wonderful. But what if our projections aren't accurate? Then it blows up in our face. And banks really don't like to lend to contractors because of this big unknown. So the way you mitigate that is you try to figure out how good are they at projecting these percentages. And when I talked about this and I wrote the article, then I was called by somebody in Birmingham and said, would you come up here and speak to our group on that? And I went, and included in the group was a CPA firm. And they came up to me and said, we do that all the time. We do what you're calculating all the time because we got to know. I mean, when you take auditing, one of the things that you're going to do is auditor has to assess management's estimates that are included in the financial statements. And so they have to say, wow, they have to have a running total of how accurate management typically is. So what I did is I took, you have a jobs in progress at year end report. It shows you every job that they had in progress at the end of 17. So the first time I find a job, I look at what they say their gross profit's going to be. Then there's another report that's called Schedule of Jobs Completed during the year. So this job would show up the first time maybe in 17. Then it doesn't show up again until 20. Well, I mean, it would keep showing up in jobs in progress, but then it shows up in completed in year 20. Then I take the actual gross profit they really did recognize and compare it to what they originally said and calculate a percentage accuracy. Okay? So if it's 90, 95, 98% accurate, you get the idea management knows what they're doing. But if it's 50% accurate, you know it's no better than throwing darts at a dartboard. I mean, they're just guessing. So then you have an idea, hey, you shouldn't be on percentage completion, you need to be on completed contract. Because you're not very good at doing this estimating.
I mean, it doesn't pertain, but what's like the variables that goes into that? Just the price of the supplies that?
Yeah,
and
because
estimation, the construction, it takes them too long to build it when they estimated it.
remember the percentage completion is cost incurred to date divided by estimated total cost. And think about it. When a company, let's just take that Shelby Hall building out there. When contractors were asked to bid on that building, they had to be given specifications, very detailed specifications for every square inch of that building. Are you gonna have marble floors? Are you gonna have concrete floors? Are you gonna have this? Are you gonna have indoor, outdoor, other kind of carpet? What are you gonna have? What's the wall going to be? Are you gonna have chandeliers? You're gonna have stuff like this. I mean, all that's gotta be stipulated, and somebody at the contracting company has to sit down and estimate what every bit of that's going to cost. So they come up with their estimate of what the total costs are going to be, and then they determine what they're gonna bid. Okay, I probably couldn't get within 50 or $100 million probably in estimating what that building costs. But let's just say that they came up with $40 million is what the cost, our cost of the materials, the labor, the overhead, the insurance that we have to have while the thing's being built, so somebody gets killed on site, we're not, we got coverage for that, all that kind of stuff. We say 40 million bucks, and it's gonna take us about 3 years to do. Okay, so the company bids, okay? We usually like to make 20% on a contract. So they would say, we'll bid $48 million, right? 48 million minus 40 million is 8 million. 8 million divided by 40 would be, that's not 40%, is it? 8 4 is 1/5, 20%. Did I say 20%? Okay, there it is, 20%. Okay. Okay, so when we get started, we're thinking, hey, we're gonna make $8 million on this contract. And we get into it, or remember the painting the inside hull of the ship example. He said his costs were going to be X, but all he did was determine his cost to paint one side of the hull. He forgot about doubling it for the other side of the hull. So because his costs were only half of what he thought they were going to be, he bid half of what he thought he was going, he bid half of what he should have. So let's say the costs were gonna be $100,000 and he said, okay, we can do it for $150,000. And when he finished, his costs were $200,000. So now even if he gets paid $150,000, he's gonna lose $50,000 on the contract. And that's what happened to the poor guy. The poor guy lost, for this company, lost $100,000 on that contract for misbidding it. But they weren't used to bidding on painting the inside hull of a ship. They were used to bidding on painting commercial buildings. Somebody goes in and builds a building or renovates a building and puts walls in and all that kind of stuff, then they would go in and do the commercial painting. Well, they were convinced by the shipping company, it's the same thing, it's just a wall and you don't have windows. It's an inside hull of a ship. Same thing, just different kind of paint that you'll have to use, but it's still a wall. But the poor guy, because he was out of his element, he just forgot to double his cost estimate. So it's possible that you think you're gonna make $8 million on this contract, and when it finally is finished, it turns out you make 400,000, 500,000, or you lose $1 million. I told you about the contractor when I first came to Mobile. A guy who had been a commercial contractor doing a lot of things, he bid to build an outdoor parking deck. And he'd never built one before. But there was being one built in the market area where he was. It was an $8 million contract. And he wanted part of it. And he thought, how difficult would this be? It's just concrete. Okay? Well, there were penalty provisions in it that had to be finished by a certain date. And he had no way of knowing how long it takes to build something like this. And think about the complexity of a parking deck. You gotta get that foundation right, and then you got all that wheeling around. I mean, it seems to me that'd be simpler than building a building, because you got water and everything else to worry about with that. But anyway, he was out of his element. He didn't have a clue how much, and he lost his butt on that. Because, like I said, he went from working for a long time, 8-hour shifts, to where he eventually figured out, hey, I'm gonna lose my butt on this because of the penalty provisions, and he wound up working 24-hour shifts to try to get the thing finished. So think about the cost. Now he's got lights that he's having to pay for, and he's having to pay people. Nobody's gonna work overnight for the same thing they'd work during the day. So he's got all kind of costs he had never anticipated having. So he lost his butt because he got in something he didn't have any expertise in. So, did I answer your question?
Yes. I'm sorry, but can you just do this problem?
11?
Yes.
Okay.
I need,
All right, I'm on page 1046 in your book. Problem 11. On July 1 of 17, Torval Construction Company, Inc. contracted to build an office building for Gumbel Corporation for a total contract price of $1.9 million. On July 1, Torval estimated that it would take between 2 and 3 years to complete the building. On December 31st of 19, the building was deemed substantially completed. The following are accumulated cost incurred, estimated cost to complete, and accumulated billings to Gumbel for 17, 18, and 19. And then A, they want us to do percentage completion, and B, they want us to do complete contract. Okay, so the first thing is determine overall contract status on each year in it. And I'm gonna do this one the way I think the student wanted me to do it. The contract price, $1,900,000, minus our estimated construction expenses. Okay, now, so look at your information. It says, cost incurred to date at the end of 17 is $300,000. And we've got estimated cost to complete $1.2 million. So that's a total of $1.5 million. So at the end of year one, our estimated gross profit on this contract is $400,000. Okay? So at the end of the first year, we think we're gonna be profitable, and we think we're gonna make $400,000 overall when we're finished. Okay? Step 2 is determine the percentage complete. and that is cost incurred to date. So at the end of the first year, they've incurred $300,000. Our latest estimate of total cost, $1,500,000. That's 1/5, that's 20%. So we're 20% of the way through. Therefore, we're thinking we should recognize 20% of the profit. So now that we've done step 1 and step 2, we can do step 3, which is develop the income statement data. Long-term construction revenues minus my construction expenses incurred in the current year would give me my, and you don't need to put the recognized, but it's the amount of gross profit that we should recognize this year. See, this is an estimate because we don't know what our actual total costs are going to be. So this is how much of that estimate we should recognize. So now I take the 20% times $1,900,000, that'd be $380,000. And then what are the construction costs that were incurred this year? $300,000. So we should recognize $80,000 of gross profit this year, and then we need cumulative gross profit row. And that's also $80,000. All right? All right, so right here is where Ms. Jernigan doesn't like it. So look at year 2. First thing I'm going to do is determine the overall contract status at year end. Well, it says cost incurred to date. That's in the 2 years, $1,200,000. And what are our costs yet to be incurred? $800,000. So what's our total cost estimated to be? $2 million. So look at that. We still can only bill the customer $1,900,000. But now we're thinking our costs are going to be $2 million. So as of the end of year 2, we're thinking, we're going to have a $100,000 overall loss on the contract. So think about that. That means when we get down here, we got to wipe out last year's profit and recognize a $100,000 loss in its entirety. So no matter what happens from here, this needs to be that. Because we want this to be that. Right? The cumulative is a total of what we recognized last year plus what we recognize this year. All right? So now, we got to do step 2, determine the percentage complete. This time, it is $1,200,000 divided by 2 million. That's 80%, right?
I think it's 60%.
No, 60%. I'm just thinking, where did I get that? All right, so now, take 60% times our $1,900,000.
760,000.
And then subtract the 780 that you recognized last year.
Oh, that's with it subtracted.
Huh?
That's with it subtracted.
Yeah, I'll click on it.
760 is how much it is, okay.
Wait, I don't understand how you, that's what I don't understand.
Okay,
Being seven-
take 60% of $1,900,000. Do the math.
Okay, it's 1,100,000.
Okay, so that's saying that at the end of this year, I'm 60% of the way through, so I should have recognized 1,140,000 in total revenues between the 2 years.
Okay,
So how much did I recognize last year? Subtract 380.
okay,
That tells me how much revenue to recognize this year. Okay? And then the expenses, yes?
Wouldn't an alternative also be taking the percentages and then subtracting that and then multiplying the percentage by?
But it won't always work that way. So don't get in that habit. Don't get in the habit of saying, okay, 20%, 60%, 40%, let me recognize 40%.
It makes it easier for me, you don't have to on this one, but when you have like a profit, so you have, the first year you don't do anything, but then the top 2 rows, you have to subtract them each year.
Oh, the 400,
No, you got 1140 in 2018, but then you subtract 380.
oh yeah, well
So
that,
then in 2019, you get your number and you subtract 760 and the 380.
right.
And then the same thing for the construction expenses, it's just.
Yeah. Well, I mean, that's what I thought we all understood we were doing.
Well, no, it is, but it's just,
So, I mean, this,
'Cause I had
60% times that is the total revenues you should have recognized to this point, minus the revenue you already recognized is how much you're defaulted to recognizing this year. All right, so now how much do my expenses have to be if I'm gonna have $180,000 loss for the current year? It's gonna be 960, 940?
Yes.
940.
That's what was tripping me up earlier.
This is the plug.
I forgot that was the plug.
Okay? So, I mean, these are my answers. The recognized gross profit is the gross profit you should or loss, is how much you should recognize in the current year. The cumulative is where you stand on the overall contract. And the reason that's important, I think we'll show you in the next one. So, all right, at the end of the next one, you're now complete. Got $1.9 million in revenues. What were your total cost? $2.1 million? Well, so your overall contract status is you lost $200,000 on this. Been better to stay home and not even work. So now our total cost incurred, $2.1 million, divided by our latest estimate of total cost, $2.1 million, we're 100% of the way there. So now to get our income statement data, we multiply 100% times $1.9 million, we get $1.9 million. That's how much total revenue we should have recognized between the 3 years. Subtract what we recognized in year 2 and subtract what we recognized in year 1, and that winds up being the revenues you need to recognize in year 3.
760,000.
760 again? Okay? All right, now look at this. You want this to be 200,000. Your overall contract status is you lost 200,000 on the contract. So this combined with what is going to give you a $200,000 loss? $100,000 loss. Therefore, 860 again is your plug. And now that we've covered chapter 22, change in estimates, did we go back and change the previous years? No, when we decided that an estimate that we made in a previous year was inaccurate, we change it now and going forward. We didn't go back and change the past. This is a change in an estimate. And when you finish, folks, this is the key. This number and this number better agree. Cause this is the final version, you're through with the contract. This is no longer estimated gross profit, this is real. And so when you get here and here, they better equal. And if you'll notice, this combined with this gives you this, this combined with this gives you this. So I mean, that's the whole point of what you're doing. Questions? Any line questions from chapter 18?
Yeah, are we gonna do the input method for anything?
The what?
The input method for there was a few that had the input method that we weren't supposed to skip them, but we've never went over the input method.
Yeah, we did.
Oh, we did, okay.
The input method is cost to total cost, cost incurred to total cost.
The explanation that Glenn gave was a lot different than what we've done.
That's because they're not as good as me. But
Okay.
do you have a specific one you want me to look at?
You know, 29 was two.
What page?
So can we do, 416, page 416, either 14 or 15? Oh, wait, yeah.
14 or 15, page 416, either 14 or 15. Let's look at both of them. All right, everybody there? All right, let's look at number 14. Frame Construction Company's contract requires the construction of a bridge in 3 years. The expected total cost of the bridge is $2 million, and Frame will receive $2.5 million. So there's your overall contract status. $2.5 million is the price, minus $2 million, we think we're gonna make $500,000 on the contract. The actual cost incurred to complete the project were $500,000, $900,000, and $600,000 respectively. So let's add that. 5 and 9 is 14 and 6 is 2 million, so we're at 2 million. So we were right on the ball there. Progress payments received, we don't care about that. That doesn't bother us. It doesn't impact what we're doing. Frame uses the input method based on cost incurred to recognize revenue from a performance obligation over time. What amount of gross profit should Frame report in the last year of the contract? Okay? So let's go to at the end of the first year, we're 500,000 out of 2 million in total contract cost, right? We're 500,000 incurred out of 2 million, so we're 25% of the way through. At the end of the second year, it says you've incurred 900,000 in costs plus the 500, so you're at $1.4 million divided by 2 million. You're 70% of the way through. So at this point, you would have recognized 70% of the $500,000 profit, or $350,000, right? So then in this last year, now you're at 2 million, over 2 million, you're 100% of the way through. So you need to have recognized all 500,000, and you've only recognized 350. So how much should you recognize in the final year?
150.
150, so the answer should be D, as in dolphin.
Yeah, that's not the way Glenn explained it. I get that. The way they did it was weird. They multiplied the overall profit by, I don't know. But anyways,
Just-
read it. Makes
This is why I'm here. Okay, good. All right, let's look at 15, since we're on a roll. Half construction company has consistently used the input method based on cost incurred to recognize revenue from a performance obligation satisfied over time. On January 10 of year one, HAF began work on a $3 million construction contract. At the inception date, the estimated cost to complete was $2,250,000. Okay, now they have to do a weird number. So we think we're gonna make $750,000 on this contract when we start. The following data relate to the progress. So we think we're gonna make $750,000. Gross profit recognized in year one, $300,000. Okay. Cost incurred in year one through year two is $1.8 million. Estimated cost to complete at the end of year two, $600,000. Okay, so cost incurred to date at the end of year two is $1.8 million. Plus costs we think we're going to yet incur are $600,000. So now we're thinking our total costs are going to be $2.4 million, right? In its income statement for the year ended December 31, year two, what amount of gross profit should be reported? Okay. Let's look at year one, and then we can go to year two. At year one, we've incurred $300,000. No, that's the amount of gross profit, sorry. That's the amount of gross profit we recognized in year one. So that's good, we don't have to do all the calculations for that. So that's my gross profit in year one, $300,000. All right, in year two, now our revenues are $3 million, and now we think our total contract costs are going to be $2.4 million. So now instead of making $725,000, we think we're only gonna make $600,000. So we're still gonna be profitable, we're just not gonna make as much as we thought we were going to make. So that's step one, the overall contract status. Step two, determine your percentage complete. We have incurred, was it $1.8 million?
Yeah.
Over $2.4 million. Would somebody please multiply or divide? 75%. Okay? So we should have recognized at this point 75% of that. But subtract the 300 you already recognized. How much should you recognize this year? 150 again? Is that right? There you go. But again, folks, here's my deal now. You encounter something like this, and you're like, okay, wait a minute. I mean, this is not exactly the way I'm used to seeing the information presented. Fall back to your 1, 2, 3 process. 1, what's my overall contract status at the end of year 2? Because that's what we're asking about here. Step 2, what's my percentage complete? So then you tell yourself, okay, at this point between year 1 and year 2, because I'm still going to be profitable, I should have recognized 75% of that figure, which I'm guessing is $450,000 based on what you're telling me. Between the 2 years. So if I recognized $300,000 last year, I got to recognize $150,000 this year. Are you with me? So, I mean, I just fall back on the teaching. Think, what would Prescott be saying if he were working this on the board? Fall back on the 1, 2, 3s, and I think it'd be all right. Are there any more in this section you want me to do in Glide?
Progress billings, are you gonna be using that term? I don't remember that, progress
billings?
No, progress, I won't ask you a question about that. I mean, it may be included in the wording here, but here's progress billings. Progress billings is, okay, it's gonna take me 3 years to build this, and I ought to be able to send you a bill, an invoice, as we go. So periodically, I'm gonna send you a bill for 200,000 or 500,000 or 800,000. And if you pay me, that's a progress billing. If I bill you, that's a progress billing. And if you pay me, that's a cash collection. But the reason we don't talk about that in here is we don't have time to devote to the balance sheet part of accounting for this like we used to when that was the biggest part of the chapter. And you'll notice in some of the problems we did do, it would say progress billings to date and cash collections to date. So progress billings to date might be $1 million, cash collections to date 800,000. What would be the accounts receivable on the balance sheet then? 200,000. The 200,000 you haven't yet collected. That's and that's balance sheet related stuff that we're not focused on.
None of the problems in Glenn, like, if it said progress billings, you just kinda had to like ignore it. That's what-
Well, I'm not gonna ask you for progress billings.
Yeah, no,
But you'll notice, didn't this question ask you to mention progress billing,
Yeah,
one
it
of
did,
these?
you just ignore it.
Progress payments received were this, and this, but that wasn't relevant to gross profit recognized. So just ignore that. We didn't mention progress billings one time and do it all of our income statement day, So that's what was important for us. All right? Now, just because we're doing this today, I still have email, I still have a phone, so if you have more questions between now and Tuesday, you can still email whatever. But I'm happy to answer everything you got now, but don't think this is it. You can't contact me after this, go ahead and contact me. And if you'll remind me, I'll try to 14. Exercise 14 is the problem in 23, okay. Okay, so is there anything else in 18? All right. Chapter 19. I love teaching chapter 19, but it's only because it was so hard for me to grasp as a student. But you people seem to have picked up on it and got it pretty easily. So I don't know that I need to go through the whole, permanent differences and temporary differences. Both of them exist. But we calculate deferred taxes for which? Temporary differences. Those key 3 or 4 things that I told you on the first day when I was lecturing on this chapter. What the basic journal entry looks like. That we're looking at differences between financial income and taxable income. And that we only calculate deferred taxes for temporary differences. And if you will memorize the 5 permanent differences that we talked about, 2 pairs and the 1 straggly one, then if it's not one of those, it's a temporary difference. It makes it easier for you to know what you're supposed to do. Remember, if financial in the year of origination, the year the difference originates, if financial income is greater than taxable income, that's the normal circumstance, and that gives rise to DTL. And another way to state DTL is future taxable amount, because deferred tax liability, deferred means you put it off until later, but you haven't avoided it, you just put it off. So that means it's going to be a future taxable amount you're going to have to pay taxes on. On the other hand, if in the year of origination, your financial income is less than taxable income, this is the unusual situation, don't have many of these, this gives rise to a DTA, which is known as a future deductible amount, which means it's gonna reduce your taxes in the future because you're having to pay it now. Future taxable amount. So make sure you're comfortable with that terminology. Anything in particular in the book, chapter 19?
The only part that I think that I have a little trouble with is figuring out when it reverses, like when on a T-chart, what years it reverses.
Okay, well, give me an example, because they have to tell you when it's gonna reverse. We can't know. So let's look at a specific one where you're talking about.
I just have in my notes, whenever we talked about it the first day, I don't think that there's like a problem that I've done yet, but.
Yeah, I'm looking.
Two reverses equal.
Look at exercise 11, turn to page 1097. Page 1097, let's look at exercise 11, bottom of the page. Read carefully what they say. At the end of 2016, Lucretia McEvil Company has $180,000 of cumulative temporary differences that will result in reporting the following future taxable amounts. So that's telling you this 180 is related to a DTL. And look how they break it down, 60, 50, 40, 30. They're telling you when it's gonna reverse, right? You can't know. It's 180,000, they told you that, but you can't know when it's gonna reverse. They have to tell you that. And so they're telling you it's gonna result 60, 50, 40, 30. And then on the next page, they have to tell you what's the tax rate. See, you can't know the tax rate either. Turn the page and they say, here are the tax rates as of the beginning of 15, 40, 30, and 25. And so then they want you to prepare the journal. And depending on those tax rates, your DTL, your tax rates in the specific years is gonna be different. And so that will make the DTL amount different. So they have to tell you the tax rate, you can't make that up. They have to tell you when it's gonna reverse, you can't make that up. Now, look at exercise 2, though, briefly on page 1095. The following information is available for Winger Corporation for 2016, its first year in operation. So it can't have any details or DTAs at the beginning of the year because it just got started. Excess tax depreciation over book depreciation, $40,000. This difference will reverse equally in 17, 18, 19, and 20. So they're taking 40,000 in a circle and saying 10,000, 10,000, 10,000, 10,000. They're telling you when it's going to reverse and how much in each year. Look at the next one. Deferral for book purposes of $20,000 of rent received in advance. The rent will be recognized in 17. So they're telling you when it's going to reverse. Next year. All of it. All in 1 year. So if you go back and look at all of these problems, they tell you when it's going to reverse. You can't know that. You can't know whether it's, unless they tell you it's giving rise to a future taxable amount or future deductible amount, you can't know if it's a DTA or DTL. Unless they tell you the relationship between financial income and taxable income. Then that's the same thing as telling you DTA or DTL. So I think if you go back and look at these, every one of them, I think you'll say, oh, okay, they are giving it to you. They just give it to you in different ways. but they are telling you. Okay, anything else? Yes, sir?
Can we work one where like the DTA is not gonna be able to be realized?
Yeah, so tell me,
I know we talked about, but I don't know.
12 and 13, exercises 12 and 13 on page 1098. You know, I can't believe it's all Miss Jernigan's fault too. I always dread this week because of the banking school. I'm over there Monday afternoon and Monday night, Tuesday afternoon and Tuesday night, all day Wednesday from 8 a.m. till 6 p.m. And Thursday morning, Thursday afternoon, and Thursday night. And then what did Miss Jernigan say? I don't think you've had enough. I want you to come in and teach on Friday too. You know, it's been since 2009 that I work 5 days a week.
Oh my God.
Rough life.
Man, you got it made.
When people ask me, when are you gonna be chair? I'm like, I don't ever want to be chair because you have to be here 5 days a week.
It's just too much.
That's like slave labor. That's ridiculous. That's exactly. I mean, you get used to working 2 days a week or 3 days a week, and you're like, 5? 8 o'clock? Have you lost your mind? So I kind of like this Tuesday, Thursday thing.
Way to go, Sarah.
So just for you, Miss Jernigan, just for you. But I've written a note in my grade report for you too, so I'll take it into consideration. All right, exercise 12 says Jennifer Capriotti Corporation has a deferred tax asset account with a balance of $150,000. So now that's very important. They're telling you there is a DTA and it has a balance of $150,000. That's not the cumulative difference. Due to a single cumulative difference of $375,000. Now see, they told you the amount of the cumulative difference and that it results in $150,000, but they had to also tell us it's a DTA. We can't tell if it's a DTA or DTL. They have to tell us that. So the cumulative difference is the 375, and I believe I remember on this it's 40%, right? They tell us that later. All right. At the end of 2017, the same temporary difference has increased to a cumulative amount of $450,000. So this is now $450 times 40%. 4 and 5 is 20, 0 carry 2, 44, 16, 108. Okay. Taxable income for 2017 is $820. The tax rate is 40% for all years. No valuation account related to the DTA is in existence at the end of 16. Now, remember what's the terminology? When do we create a valuation account to reduce the DTA? What's the term?
More likely than not.
When it is more likely than not that you're not going to realize the full benefit. So at the end of last year, we didn't have any reason to believe that it needed to be created. A, record income tax expense, deferred income taxes, and income taxes payable for 2017, assuming that it is more likely than not that the DTA will be realized. Okay, now, so the journal entry is debit income tax expense. And I did have a DTA this year, so debit DTA. We didn't have a DTL. They didn't even mention DTL. Nothing about that. So I don't have a DTL to do, but I do have to do income tax payable. Well, income tax payable is based on taxable income, and taxable income, they tell us, is 820. So 820 times 40% is 328,000. And then the DTA, here's the question. If it was 150 on the first day of the year, and now you've calculated it needs to be 180 at the last day of the year, how much do you increase it by? 30,000. So that's 30,000. And so this is 298 by default. All right? Now look at B. B changes it up a little bit. B says, now, assume that it is more likely than not that 30,000 of the DTA will not be realized. What journal entry would you record at the end of 17 to recognize the valuation account? Okay, so now they're telling you allowance to reduce DTA to net realizable value. You're saying now, I think the net realizable value is 150,000. 30 of that I don't think I'm ever going to benefit from. So you're saying I need 30,000 on this side. Because 180 minus 30 is going to give me my 150. If I put a debit over there, I'm going to add it to it. Two debits equal a greater debit. So what's the journal entry to recognize the creation of that? It's debit income tax expense and credit the allowance to reduce. $30,000. So it's not that big a deal. Remember, DTAs are not nearly as common as DTLs. But when you have to create a DTA, you have to also consider, am I going to really be able to benefit from it? Because it has a limited life. Am I going to be profitable enough to save $180,000 in taxes in the future? That's what the question is. I mean, 450,000 reversing. I mean, that's a lot of income, isn't it? 450,000. I got to have 450,000 before this DTA expires. That's what you're saying. And in the first case, we said, okay, we think we're going to be. And then in B said, nope, you rethought it, and now 30,000 of it you don't think you're ever going to realize. Okay? Does that address your question, Mr. Jackson? You want to do the next one?
Well, yeah, if we could.
Okay, you want to do 13. Assume the same information as in 12, except that at the end of 16, Jennifer Capriotti had a valuation account related to his DTA of $45,000. Okay? So now they're changing it up and saying that at the end of last year, you had $45,000 in the in the valuation account. A says record income tax expense, deferred income taxes, and income taxes payable for 17, assuming that it's more likely than not that the DTA will be realized in full. Well, the first thing we got to do is that journal entry again for the current year. So on 12/31/17, you're going to debit income tax expense, debit DTA, and credit income tax payable. 298, 30, and 328. That's the first thing. Then it's telling you, you don't need this at all. It shouldn't even be here. You think you're gonna realize the full benefit. This business has turned around and we think you're gonna have enough taxable income in the future to save this in taxes. Therefore, let's get rid of the 45,000. Well, then we would debit the allowance to reduce 45,000. And what you gonna credit?
Income tax.
Income tax expense.
So when it's going the other way, it's just flip flop.
You don't
Yeah.
have it anymore. Well, you don't know it anymore.
I mean, and this is a change in estimate again. At the end of last year, you thought as much as 45,000 of that 150, I'm not gonna be able to realize. So you created an expense last year when you debited income tax expense and credited the allowance account. Now at the end of this year, your estimate has changed. You think, nope, I shouldn't have 45,000. I don't even need the valuation account. So you change your estimate, but we didn't go back and change the past. We changed the expense this year. We recognized a reduced expense this year compared to last year. Okay, now in part B it says, at the end of 17, you decide none of this DTA is going to be beneficial to you. Isn't that what it says? Assuming it's more likely than not that none of the DTA will be realized. So that means you want this to be zero, the net amount to be zero, so this has to be 180,000. Okay, you would still do this entry, but then what would be the second entry?
Debit income tax expense for the 418,
How much?
180,000.
No,
135.
it's already got 45.
So, yeah.
Now you go, what is that, 135? And credit the allowance. 135. See, always draw the T account and know what the balance is, and then where do I want to go, so that how much do I need to do? Okay? Any other specific questions? Yes, ma'am?
Can you do number 4, because number 4 is where you have to calculate the taxable income, and then you have to do, hang on, so I was looking at.
Okay, you're talking about exercise 4.
Oh, right, exercise 4.
Turn to page 1095, exercise 4.
Because that one's like, you also have to do what it looks like on the income statement and the effective
Okay.
tax rate.
Zurich Company reports pre-tax financial income of $70,000 in 17. The following items cause taxable income to be different than pre-tax financial income. Okay, so we have pre-tax financial income, did it say 70?
Yes.
Okay, and then we have some differences. Number 1, depreciation on the tax return is greater than depreciation on the income statement by 16,000. So excess tax depreciation is 16,000. Okay, now, what they're wanting us to do is go to taxable income. Okay? Well, then I have to subtract. They're telling me an expense on the tax return is greater than the same expense on the income statement. So I gotta subtract. Okay, number 2. Rent collected on the tax return is greater than rent recognized on the income statement by $22,000. So this is going to be excess rent revenue for taxes. 22,000. And that's plus, I gotta add that on my tax return because they're telling me it's on the tax return and it's 22,000 greater than what's on your income statement. Pre-tax financial income is what's on the income statement. Okay, look at number 3. Fines for pollution appear as an expense of $11,000 on the income statement. Well, that would be non-deductible pollution fine. How much was it? 11. Okay, what are we gonna do? Add or subtract it? Add. See, it's been subtracted to get to that 70, but you can't deduct this on your tax return. So you have to add it back. So, that'd be 87,000? Your taxable income this year is 87,000. Let me look and see what they're asking us to do. Tax rate for all years is 30%. There are no deferred taxes at the beginning of the year. A, compute taxable income. Well, there you have it, 87,000. B, and income taxes payable. Well, income taxes payable is simply multiply this times 30%. 3 and 7 is 21, 1 carries 2, 3 makes 24, 26,100. So there are your answers, 87,000 and 26,100. B, prepare the journal entry to recognize, report income tax expense, deferred income taxes, and blah, blah, blah. Okay, so, all right. The excess tax depreciation as a result of that, what is the relationship between financial income and taxable income? Financial income is greater than. Therefore, this gives rise to a DTL. Okay? What's the relationship between these two? Taxable income is greater or financial income is less. Therefore, that gives rise to a DTA. And for this last one, it is a permanent difference, therefore we're not going to recognize anything for it. So, the journal entry is debit income tax expense. We did have something giving rise to a DTA. We did have something giving rise to a DTL. And we have to pay income taxes payable. We know income taxes payable is $26,100. Okay, now to get the DTL, it is the temporary difference arising this year times the future tax rate. 3 and 6, 18, 8 carry 1, 4,800. The DTA is the temporary difference giving rise this year times the future tax rate is this 6,600. And income tax expense is the plug. 26, 30, 30,900, 24, 3.
Yes.
Have we done the part that you want me to keep going?
No, can you just go over the part D where it says the effective income tax rate?
No, that's what I told you to skip.
Okay, so we didn't do that,
We
okay.
didn't do anything on that.
I did all that because you want me to do something that I
Oh,
told you
no,
to
I
skip.
wanted you to do that
Okay.
part too. Yeah, no.
But yeah, no, I didn't, I don't want you, I don't care about you doing part D. All right, how we doing? Anything else from 19?
Would we be responsible for creating a schedule to calculate the total cumulative deferral, whether it be an asset or liability? Because there are a few problems where like it asks for what the actual deferral will be, like the difference between the two.
Yeah,
On the income
gotta note
statement.
that, yeah. Put that on the, you talking about where you net them and put them on?
But yeah, but
the
like
income?
there's some where like we make a whole schedule, or that's kind of like how I do it. But sometimes you might
Can
ask.
you point me in the direction of one?
Might take a minute. Go through my. Okay, well, yeah, so like, I mean, I guess for this one, whenever I worked it out, I did make
Which one is it?
19-4, the one you just did. But for this
Problem
one,
or exercise?
the exercise. But whenever I did it, I created a schedule. Are you gonna ask us to make a schedule on the exam? You like making, like, you love the schedules.
But how do you know when it's going to reverse?
Well, I mean, not.
You don't,
No, not
so
for the
you can't schedule it. They don't tell you when that 16,000 is going to reverse. They don't tell you when the 22,000 is going to reverse. So I don't know how you did that. But it's 30% for all years, so it really doesn't matter. I mean, we just use the 30%. Now, when you do one like exercise 11 that's on the same page, it's, the tax rate isn't 30% in all years. Sometimes it's 25, sometimes it's 30, sometimes it's 35, so now you do have to map it out
Okay.
when the tax rate changes. But if they tell you it's 40% for all years, then I don't have to do any scheduling out mapping. But when it tells me like this, 180 is gonna go 60, 50, 40, 30, and they're different tax rate in those years, then I gotta map it out and do the multiplication.
And when it comes to getting the future tax rate, it's always the next year.
It's whatever year.
It's whatever the enacted tax rate is when the thing is scheduled to reverse. So, if you're sitting here today and this DTA or DTL is created and your tax rate is 40%, that doesn't matter. It's what is the tax rate when this thing is going to reverse. In fact, when I did the journal entry, okay, income tax payable is taxable income times the current tax rate, because that's what we owe today. We have to pay taxes based on today's tax rate. For the DTL is the temporary difference that gives rise to that created this year, times the future tax rate when that thing's going to reverse. And in this case, the tax rate is 30% for all years, so I multiply 16,000 times 30%. Then for the DTA, it's also the temporary difference giving rise to that DTA this year times the future tax rate when that thing's going to reverse. And then income tax expense is the plug. So that's critical knowledge that you gotta be able to distinguish between the current tax rate and the future tax rate. But they have to tell you, you can't make it up. I mean, you can't just say, okay, I think the future tax rate is gonna be 50%. I mean, they have to tell us this. Questions?
Okay, now can you just like say something about net operating loss? Because I'm still a little confused about it. Like I understand that it goes back 2 years, you get your income tax back. I don't understand like what that looks like. Like how do you, like what kind of problem is that?
Okay, example of that would be, what is it, exercise 25. is a good example of a net operating loss with both a carry back and a carry forward. And they tell you in the information below the little chart with the numbers, the enacted tax rate was 34% for 15 and 16. So put a little bracket around 15 and 16, and out to the right, write 34. And 40% for 17, 18, and 19. So put a little a bracket around those 3 years and write 40%. Then they tell us, assume the carry back provision is used first. So now that's our option. When we have a loss like we have in 2018, we're sitting there with a $570,000 loss. And that's a year when the tax rate is 40%. We could have elected to not go carry back. We could have elected to just carry it forward because the tax rate in all these years is 40%. But we elect to carry back because we can get immediate refunds for the taxes we paid in each of the first 2 years, those previous 2 years. That makes sense? I mean, listen to me now. If we carried it forward, we might be able to save ourselves taxes based on 40%. Might be able, if we become profitable, to save taxes at 40%. But if we carry it back, we're going to get a refund for taxes paid at 34% in 2016 and 40% in 2017. So we can either sit here and hope we're profitable enough to save money in the future, or we can do something that we know we're going to get refund. We're going to get a check in the mail from the IRS. Most people would elect, let's get that check today. Okay? So that's what they did. They asked for a refund on the taxes we paid on $350,000. And since you lost $570, you have a $570 NOL. You carry it back and you say, give me a refund on the $350,000 times 34%, and that leaves you with a $220,000 NOL to carry against the next year. And that next year you had profit of $120,000, and the tax rate in that year was 40%. So now you've got a $100,000 NOL to carry forward. And the tax rate is 40% in all those years. So that should be a $40,000 DTA for us. So we would get a refund of this for that amount, and this, which was 48, what is this, 69? What's 350 times 0.34? 119.
Yeah, 119.
119 and 48 is 167. So we're gonna get a refund, we're gonna get a check in the mail from the IRS for $167,000 when we send this return in. And we've still got $100,000 of the NOL to carry forward in future years to reduce taxable income in the future. So I would go back and watch the exercise 25 LiveScribe LiveScribe video for that one. Questions? Okay. Chapter 23. I've already heard Ms. Jones say she did something wrong on the extra handout problem.
I have an idea, I'm not too
okay? I've got a solution here that I'm looking at that is on the indirect method. So get your extra handout problem example on Easton Inc. And I guess I did part B, prepare statement of cash flows using the indirect method. Everybody got that out? Okay, let's talk about it. Ms. Jones, I'm gonna go through here. Cash flows from operating activities, 71,400, net income, 71,400. That's net income. Then adjustments to convert net income to net cash blank by operating activities, colon. The first one I show is gain on sale of equipment, $400, and it needs to be negative. You didn't do it.
I didn't have time.
I know, y'all pick Friday. It's like, yeah.
Gain on sale of
I'm here.
equipment, 5,500, and that's also negative. Depreciation expense, $13,800 positive. Then I'm going to my current assets. Change in accounts receivable net, 23,900. Change in inventories, 4,600, positive. Change in salaries and wages, change in accounts payable, 7,000 negative. And change in salaries and wages payable, 5,600 negative.
Oh, yes.
So when you total the adjustments, they equal a negative 24,000. When you combine that with the 71,400 of net income, you get net cash provided by operating activities, 47,400. Okay? Then from investing activities, first you have proceeds from the sale of equipment, 2,200. Proceeds from the sale of investments, 29,500. Purchase of buildings, a negative 22,000. And purchase of equipment, a negative 25,200. When you combine those four, you get net cash used by investing activities, a negative 15,500. And then cash flows from financing activities, the repayment of notes payable, a negative 15,000, and the payment of cash dividends, 10,000, negative. When you combine those, you get a negative 25,000 of net cash used by financing activities. So now we combine the 47,400 minus the 15,500 minus the 25,000, and we wind up with cash, change in cash during the year, 6,900. Cash at the beginning of the year, 33,600, equals cash at the end of the year, 40,500. So, look at the T accounts that I wrote on this. Up in the upper left, I put equipment at the beginning of the year was 41,000, and at the end of the year was 60,800. During the year, you sold equipment that cost $50,000. 5,400. So if you take 41,000, subtract the cost of 5,400 from the total, and then solve for what you need to have at the end of the year, 60,800, you made a purchase of equipment of 25,200. Okay, look down below. Accumulated depreciation, you had a 35,900 balance. You must have had accumulated depreciation on the equipment that was sold for 3,600. That gives you, you should have had a balance of 32,300, but you wound up with 46,100. So how much was your depreciation expense? 1,380. Go to retained earnings, top right corner. You started with 67,200. You had net income this year for 71,400. Evidently, they tell you something in the problem about a stock dividend for 37,500, which is non-cash. So then you have to figure out what is the cash dividend. And that was 10,000. If you wind up with 91,100 at the end of the year. Then look in the bottom right-hand corner. Accounts receivable net at the end of 13 was 93,000. Accounts receivable net at the end of 14 was 116,900. So the change in accounts receivable net is 23,900 increase. Questions?
It's the bad debt of 4,100, but yet your allowance was only a difference of 6, so there's like $3,500 floating around up the bottom.
No.
No, I mean, but on direct method, we don't just immediately deduct that?
No, I'm gonna show you.
Yeah, that's what screwed me up.
Okay, the allowance for doubtful accounts, you're saying at the end of, it's 3 and then 3,600.
And under operating expenses.
Wait a minute.
it's worse.
So bad debt expense is what causes this to change, right? So do they tell me, yeah, they tell me 4,100 of bad debt expense. That's in the income statement, actually.
Yeah, 'cause
So if I add the 4,100 of bad debt expense, if nothing else happened, my balance would be 7,100. But that's not my balance. My balance is 3,600. So something happened on this side.
we recovered some,
You know.
right? Well, didn't. You're writing it off.
Your write-offs. When you write off an uncollectible account, the journal entry is that. So my write-offs had to be, what, 3,500? And remember, we use that as a deduction in cash collected from customers because it makes accounts receivable go down, but you didn't collect anything, so you need to subtract it in cash collected from customers.
That's where I missed it.
Yeah.
Thank you. The right, I knew there was something 3,500, but I was like, where does it go? Identity account.
I got messed up on the investments, available for sale investments. And I thought they were included in the top part, but it's recorded in this, but the difference is recorded in
It's
the
in
sale,
investment.
in the investing.
Yeah. Evidently available for sale at the end of 13, 65,000, and then at the end of 14, 41,000. Okay? So, what did I say, 60? And then 41?
60,041.
Okay. Okay, and then it tells me in the additional information, investments that had cost 24,000 were sold for $29,500. Well, then I would take the cost out of here. Well, so I didn't buy any more, did I? So what I need to show is proceeds from the sale of investments, $29,500, and deduct the gain on sale in operating activities for $5,500.
That sucks.
Huh?
I hate saving up cash flow.
You hate statement of cash flow.
Alright, it's a lot of thinking, that's what I was.
Well, let's don't do anything we have to think about.
I just feel like, for me, going through it, I can skip over so much, just like not.
That's why I say you gotta be very methodical. There are 4 types of adjustments. And if you answer this wrong, I'm gonna throw something at you. In operating activities on the indirect method. What's the first type of adjustment we did typically? Non-cash income and expenses. Then what'd we do? Gains and losses on asset sales. What's the third type of adjustment? Change in current assets. And then change in current liabilities. So you just have to methodically go through and make sure, okay, I'm looking at my balance sheet. See, this one isn't broken out. So you gotta figure out what's current. So you say, well, I know cash, but I'm trying to explain the change in cash. Accounts receivable, all other things equal, that's a current asset. Inventory, that should be a current asset. Available for sale securities, we should remember from chapter 17, plus I also said on the thing, the only thing that's current is trading securities. So now I'm gonna stop, not going any further for current assets. Now I gotta go to current liabilities. So go to the other side. Allowance for doubtful accounts, that's a contra asset account. Accumulated depreciation, that's a contra asset account. Accumulated depreciation, contra asset account. Okay, accounts payable, that's my first current liability. Salaries and wages payable, that's my next current liability. Long-term notes payable, well, that's a long-term liability. So I stop now. I've done operating activities.
You don't put any notes payable in the adjustment, right? Even if it's short term?
Even if it's short-term, no, because all notes payable are financing activity. Financing activity. So, I mean, I agree, you have to be calm and take your time, but remember how you've been taught to do it methodically. Yes, sir.
I'm trying to confuse, but under the indirect method, you did the other day, asset going up, cash goes down. And then liability is the same and equity is the same.
They move the same direction as cash.
So, I'm trying to, when you add or subtract them, you do, under the indirect method, you do whatever cash is doing.
That's right.
For that account. Okay.
That's right. But on the direct method, you have to do, am I solving for cash collected
Okay.
or cash paid?
Cash collected, it's whatever cash is doing.
Right, that's,
Paid, it's opposite of what cash.
that's exactly right.
It's easy.
Yeah, the inventory messed me up at first, I was like, no. 'Cause my inventory
That's
went
what
down,
bothers
but
most
it
students,
was
is they're like, well,
Well-
sometimes we add it and sometimes we subtract it, and I'm confused.
You said you don't remember the accounts and stuff, but I knew there has to be a way to remember it
Yeah.
somehow. And
I do have a question. For the direct method, if we don't do operating, like cash paid for operating expenses, but they're like selling and administrative.
I'm not gonna break it out. I will do operating expenses.
I don't even get why some classes teach the statement of cash flows before this one. I feel like it just causes confusion, like
What
in
now?
principles and in 371. Like when we were learning about the statement of cash flows, but we really didn't learn anything about it. It was just like a really, really like basic little review and
All
like
you did was add.
there'd be
In
questions
principles?
on. Mm-hmm.
Yeah, we did the indirect and said you're gonna get into it at 372, that's everybody's famous last word.
Well, I mean, yeah, you do. You don't do the direct method at all
No.
because it's a lot for a principal student to absorb. And think about it, if you're gonna be just a business major, you're probably only gonna ever see an indirect method statement of cash flows. But if you're gonna be an accounting major and be tested on the CPA exam on both methods, then you have to be taught both methods. But I kind of wish some principal, we got some data the other day. When people take the ETS, the Education Testing Service exam, when they graduate, and when you're a Management 485, you also have to enroll in 486, which all that is you have to take a test. So it's not a separate class that you have to go to or anything, it's just a test that you have to take. And we look at, when you fill out the information when you're taking the exam, you have to say what you're majoring in. And we look at accounting majors, how they do on the accounting portion of the ETS. And our accounting majors as a whole score in the 99th percentile. And we don't think they even give you 100 percentile. So we think we score at the top. But then they break it down between native students, which means people who came here as freshmen, University of South Alabama students, and stay through and graduate, versus transfers from two-year colleges, and then transfers from other four-year colleges. They break those out separately. The transfers from junior colleges, two-year colleges, score in the 48th percentile on that exam. And the transfers from other four-year schools, people who go to Auburn, Alabama, or some other four-year school and then just have to come home for whatever reason or come back here for whatever reason, they score